tapering should soon end, and US monetary policy should normalize. Yet there are some intriguing signs, amongst which John Williams' declaration that QE4 might be in order. So we've asked Eric Vanraes of EI Sturdza to enlighten us a bit on what is going on with US central bankers. Eric, welcome to the studio.
Thank you, Nicolette.
Now, the first point is that there are contradictory signs, but yet the markets are interpreting them very differently, equity and bond market. Can you tell us a little bit about the signs and the interpretation?
Yeah, since the beginning of the year until last week, the equity markets and the fixed income markets didn't tell us the same story, because it's always in the US the story of the glass half full, half empty, and the S&P 500 was telling us that the US economy is recovering, but if you look at the evolution of the 10-year Treasury notes year to date, it's frightening, because the bond market tells you that the story is not so bright, and the fixed income markets tells us that even if tapering is ending now, and we are all wondering if the first Fed fund rate hike is for Q1 or Q2 of next year, and some Fed members, as you said, Mr. Williams of San Francisco, maybe some Fed members tell us that it's more complicated, and the most interesting is what Mr. Bullard of the Fed of St. Louis told us last week, because Mr. Bullard is one of the most hawkish members of the Fed. A few months ago, he was telling us that it would be not good for the US economy that the Fed start to rise the Fed funds in Q2 of next year, because he was in favor of as soon as possible. So Q1 of next year, maybe the end of this year. And now Mr. Bullard is telling us that the deflation in Europe is a concern. It is more important than previously thought, and that if the European deflation is imported in the US, maybe the first rate hike could be delayed, and maybe a QE4 could be done if necessary.
That's quite extraordinary, but apart from contamination from deflation in Europe, which sounds like a far-fetched story, isn't it more to do with the US employment market, which theoretically has gone down quite considerably, but there is a story behind the story?
Yes, and my first remark is that Mrs. Yellen said very clearly that the Fed doesn't look anymore at this unemployment rate. There were, when Mr. Bernanke was in charge, they were too optimistic, and they mentioned this unemployment rate in their statements. And Mrs. Yellen corrected this mistake, because she knows that this unemployment rate doesn't mean anything anymore, because, of course, if you look at the figure, unemployment rate is fantastic, from 12% to just below 6% now. It's just amazing. The problem is that if you analyze the figure, you see that the participation rate is falling dramatically, 62.7% now. It means, if you want to show more figures, it means that since the crisis of 2008, more than 14 million people left the panel of the statistics. And these 14 million people, nobody knows what they are doing currently. Maybe they didn't find a job, or they are in the street. So it's not so fantastic. And the major factor of improving situation of the job market in the US is unfortunately this decline of this labor force participation. During the crisis, it's just to summarize, you have 1 million jobs created, but 14 million people out of the statistic.
Yes, it's a bit out of proportion, but that's not the only sign of concern. One of them is the new, what you refer to almost as the new subprime, is the auto sale market. And the fact that it looks very healthy, which we could say booming, but yet behind that again, there are changes in the conditions of this market.
Yes. Same story. If you just comment the figure, it's bright. 16 million car sales in the US before the crisis. They fell to around 9 million, and now we are above 16 million. So the figures more or less the same as before the crisis. But if you analyze the details, it's a bit frightening because, as you said, it's maybe it's the same mistake as a subprime in the real estate market many years ago, because they extending the conditions of leasing. Now it's 7 years without a minimum requirement of first contribution, and with very low rate, because the subsidiaries of the car companies are now banks instead of financial companies, so they can refinance at the Fed at a very low yield, so they can lend at a very low yield as well, and there is no condition. For example, before they were obliged to ask you if you have a job. Now it's not anymore the case. And
that does remind us of the subprime.
And the figure is increasing dramatically because, in addition, of course, the average duration of the car market in the US was increasing in the past, because between 2008 and 2011, of course, the US car sales was below the average, so the average age of the car
well, it was longer.
Was longer.
But this also actually applies on the real estate market, because it appears that the bump in the transaction volumes is largely due to brokers buying rather than the individuals or the end consumer.
Yeah. Unfortunately, we don't have the figures, so we cannot analyze exactly the situation. But many sources of information we have in the US tell us that the spike in the number of transactions, and of course the rise of the average price of house, is due to real estate brokers, and it's always the same story. As they can borrow at the Fed at zero yield, so after they can invest in this market. And more generally, there is a problem in the US because they know that they have the toolkit, the toolbox, and they used all the tools, and now the toolbox is empty, and they don't see the sign of a very, very robust growth. There is growth, but it's disappointing, and it's not solid, and we have signs that it's not a robust start of growth. So the last link is consumer confidence.
That's right, because 2/3 of this growth is consumption.
Yes. Yeah.
So if that reverses, that's the end of the growth.
Yeah, it's frightening because consumer confidence is key now, and maybe these figures are not totally true, but there is one consequence, is that consumer confidence is still good.
Yes.
And it's very important for the US economy, because all these market participants, of course, Obama administration, but the Fed and the bankers and even the media, they have one goal, to protect consumer confidence, because if consumer confidence falls, household consumption will fall as well, and it is really a big problem for US growth in the future.
Okay, Eric, thank you very much, although the news weren't that great, but sometimes one has to confront them.
Thank you very much, Nicolette.